Right now, something unusual is happening in the AI market. While trillion-dollar companies dominate headlines, a different layer of AI is quietly expanding underneath the surface. Smart city surveillance systems, AI-powered infrastructure, real-time analytics networks, enterprise automation layers. And yet, some companies connected to these systems are still trading at prices most investors completely ignore. One of them is trading at just $0.32, and another sits around 154 fours. Now this is where things get interesting. How do companies connected to AI infrastructure end up trading at levels disconnected from the broader AI boom? But here's the catch. What if the market isn't overlooking AI itself, but the infrastructure layer underneath it? Because while everyone watches consumer AI, institutions often pay attention to the systems operating behind the scenes. The AI market is evolving beyond software. We're now entering the infrastructure phase. Cities are integrating AI surveillance systems. Enterprises are automating analytics workflows. Governments are expanding intelligence and monitoring capabilities. And this is where pricing inefficiencies usually exist. Most retail investors focus on visible AI names, while institutions quietly monitor the back-end infrastructure. This is the type of layer institutions quietly watch. Now, this doesn't guarantee anything. These are still smaller cap companies. Volatility remains high. Execution matters. Timing matters. But it explains why this area matters. Because if AI adoption continues moving deeper into infrastructure systems, this is exactly where smaller cap opportunities tend to form. Most investors think AI is only about chatbots, automation tools, or content generation, but one of the fastest growing AI categories is something much more physical: AI-powered surveillance and smart monitoring systems. And this becomes increasingly important as cities become more connected and data-driven. But here's the catch. Very few investors pay attention to the infrastructure layer until adoption becomes impossible to ignore. And this is the part most people miss. Companies building real-world AI systems often remain overlooked during early stages of adoption. Interestingly, the second company we'll discuss later takes a completely different approach, focusing more on enterprise AI analytics and advertising intelligence. This company operates in the AI surveillance and smart city infrastructure layer. That includes AI video analytics, smart monitoring systems, public safety infrastructure, and real-time surveillance intelligence. As cities become increasingly automated, demand for intelligent monitoring systems naturally grows. And if this layer expands, companies like this become critical. Because AI infrastructure is no longer limited to software, it's moving into physical environments. This stock has already experienced a major volatility cycle. Shares previously traded above $4 during earlier AI enthusiasm phases, then pulled back sharply as speculative small-cap sentiment weakened. And now, the stock trades around $0.32. Now the question becomes, is this simply another forgotten penny stock or an overlooked AI infrastructure company sitting inside a neglected market gap? The company focuses on AI-driven smart surveillance systems used in smart city infrastructure, public safety monitoring, intelligent video analytics, and enterprise security systems. Its business revolves around applying AI to real-world monitoring environments. And when you actually look at the company behind this is where things shift. The stock is iVida Solutions, ticker IVDA, currently trading around 0.32. So why hasn't the market fully priced this in? Because smaller cap infrastructure companies often struggle with visibility and investor confidence. This doesn't mean it moves tomorrow. There are real risks here. Execution, adoption speed, and market sentiment all matter. Timing is the key factor. Now, before we get into the second stock, here's something most people completely overlook. Even though AI demand is exploding globally, Many infrastructure-focused AI companies still see delayed market reactions because investors usually chase hype first and infrastructure later, and historically, that's exactly where pricing gaps tend to form. But unlike the first company, this one operates much closer to enterprise AI analytics and advertising intelligence systems. Where the first company focuses on physical AI infrastructure, this one focuses on AI-powered data interpretation and audience intelligence, and that creates a very different type of opportunity. This company develops AI systems designed to help businesses understand user behavior, advertising performance, and data-driven decision-making. Its technology focuses on AI-powered audience analytics, advertising intelligence, enterprise-level data interpretation, and automated optimization systems. In simple terms, it helps companies make smarter decisions using AI-driven behavioral analysis. If AI adoption continues expanding across enterprise systems, then companies specializing in AI-driven analytics naturally become more relevant. Because eventually, businesses don't just need AI tools, they need AI systems capable of interpreting massive amounts of user data efficiently. And this is where enterprise AI infrastructure becomes important. This stock has also gone through major market volatility. Shares previously traded above $8 during earlier growth cycles, then collapsed alongside broader speculative tech weakness, and now the stock trades around $154. Now the question becomes, is this company permanently discounted by the market or simply waiting for enterprise AI demand to accelerate further? And this is where it gets interesting. The company is Inuvo, ticker INUV, currently trading around $154. But here's the reality. Enterprise AI analytics companies still face uncertainty around long-term scaling and profitability. This doesn't guarantee anything, and there are real risks here. But market gaps often exist where attention remains limited. Now, compare both companies carefully. One operates in AI surveillance and smart city infrastructure. The other focuses on enterprise AI analytics and behavioral intelligence. One trades near microcap territory at just $0.32. The other sits above $1 with stronger enterprise positioning. So which one benefits faster if AI infrastructure spending accelerates? If smart city and public safety systems expand aggressively, the first company could benefit. But if enterprise AI automation scales faster across businesses, the second company may gain institutional attention more quickly. And this is the part most investors miss. Infrastructure layers often move later than hype cycles, but sometimes much more aggressively once adoption becomes visible. At the end of the day, both of these companies sit inside the same broader trend: AI infrastructure. Not consumer AI hype, but real-world systems operating underneath long-term AI expansion. And historically, this is the layer that tends to move later, but often more aggressively once institutions begin pricing future adoption more seriously. If you want more breakdowns on overlooked AI infrastructure stocks trading under the radar, subscribe, because the next phase of AI investing may look very different from the first.